All right, moving right along, this lesson is going to be all about continuation patterns. Now, a major part of TA is determining whether or when to buy or sell in a formidable trade. Now, knowing when to buy in and when to sell is going to be really crucial to your success. So understanding how these patterns are formed and how they will play out is very, very important. Now, while these are very common continuation patterns, there are quite a few more, and they do get pretty complicated the more in depth you go. But the ones we are going to go over in this lesson are very common, especially when trading Bitcoin and other cryptocurrencies. Now, these patterns will help you forecast future price movements, and it really doesn't matter what you're trading, whether it's crypto, forex, or stocks. These things show up all over the place. Continuation patterns do not predict the future. However, they do help with locating the probability of movement within a particular trend, and I promise that these powerful buy and sell signals will help you make much more accurate investment decisions. So with all of that said, let's go ahead and get going. All right, so continuation patterns, as I mentioned, will tell you whether a price movement is going to continue moving up or down within a prevailing trend, hence the name continuation patterns. For example, if price movement of a downtrend shows signs of a continuation pattern, what would you do? If you guessed buy in, then keep watching this lesson. The correct answer would be wait until a reversal pattern emerges, or you could just move on to another trade. So let's go ahead and start with the 6 most popular continuation patterns, 6 patterns that you will see on the Bitcoin and other crypto charts as you evolve into a successful trader. All right, the first one. So this one can be called a number of different things, but for the sake of simplicity, we will just call it a rectangle continuation pattern. This can often be confused with a flag or also a pennant. Now, this continuation pattern depicts sideways price movement between 2 horizontal trend lines. We also call those support and resistance, along with an uptrend, which generally results in an overall uptrend continuation. Now, in order to be defined as a true bullish rectangle, price movement should touch each trend line at least 2 times on both support and resistance, and upon doing so, the price action should break the top trend line of the resistance. Now, investors want to purchase the asset, whatever it is you're trading, crypto, Bitcoin, stocks, forex, whatever, when the price action closes. That means a candle body closes above the upper trend line. Now, in this bullish rectangle, the confirmation to buy is going to be when you do get a close above the upper trend line. Pattern confirmation will be when you get 2 touches on both support and resistance. Now, this pattern reaches its measured move about 80% of the time, and the way you take your measured move is if you take the high to the low of the consolidation pattern in between the 2 support and resistance lines, and you add the distance to that at the breakout of the upper trend line. Okay, so as with bullish continuation patterns, they typically have a inverse twin. So the bearish rectangle depicts sideways price movement between 2 horizontal lines, support and resistance, along a strong downtrend, which generally results in overall downtrend continuation. So in order to be defined as a true bearish rectangle or a bearish flag or a bearish pennant, these are really kind of hard to determine the difference. How you will know the difference is if the rectangle, the top and lower trend lines, the resistance and support, are basically parallel to each other with about 0 degrees from A to B. So upon identifying this pattern, the price action should break the bottom trend line of the resistance when it does break out. To summarize this pattern, a confirmation to sell or a confirmation that price is going to continue movement to the downside. This confirmation will be when a candle body closes below the lower support trend line. Now, the pattern confirmation, the way you know that this is indeed a bearish rectangle, you will get 2 touches again on both the support and resistance trend line, and this breaks to the downside about 50% of the time. All right, moving right along, triangles. So this is one thing that this is a pattern that we did mention in the intro video, and this is a very, very, very common pattern that you will see in all markets, not just crypto. The first triangle continuation pattern we are going to discuss is the ascending triangle. Now, this is a bullish continuation pattern, and it's depicted by a right triangle, which is created by two trend lines. The bottom trend line is drawn horizontally upward, where support prevents the price action from breaking through. Now, the top trend line is represented by a horizontal level, which prevents the price from breaking through this resistance. And once this resistance line is broken, upwards price momentum is expected to continue. Now, this pattern showcases the demand for the asset is increasing over time. And you see these, actually, we are looking at this right now as Ethereum just recently broke out of an ascending triangle, which is very bullish. So to summarize this pattern, so your confirmation to buy will be when price closes above the upper trend line or above the upper resistance. Now, you'll know this is indeed an ascending triangle when you get your pattern confirmation, and your pattern confirmation is two touches on both support and upwards horizontal resistance. Now, this pattern will break to the upside about 75% of the time. So if you are trading this pattern, it's always crucial to have a bearish possibility in mind before entering into any bullish trade. Now, how to take the measured move of the ascending triangle? You again will take the high to the low in the consolidation range and add that to the point of breakout, either to the upside or to the downside. In this case, for a bullish breakout, you would add it to the upside, just on the other side of the upper trend line or the resistance of this pattern. And as I mentioned before, every bullish pattern has its inverse twin, and this inverse twin would be the descending triangle. So as the bullish pattern is depicted by two closing trend lines on each other, this one is essentially the same, where the bottom trend line is drawn at a horizontal level where support prevents price action from breaking through. The top trend line is represented by a downward horizontal line, which prevents the price from breaking through this resistance. Now, once this resistance line is broken, downward price momentum is expected to continue, and it is recommended to sell here. Now, this pattern showcases that the demand for the asset or crypto is weakening over time. So to confirm the pattern, to actually sell or short the position is going to be when the price closes below the lower trend line, meaning you get a candle body close completely on the bottom side of the support lower trend line. So to confirm you are actually in this pattern, you are looking for two touches on both horizontal support and the downward resistance line, and this pattern will break to the downside about 54% of the time, which makes it, barely a bearish pattern, and this indeed does break to the upside pretty often. We saw this very recently with Bitcoin. Okay, so moving on to the next continuation pattern, the most common and the most well-known of the continuation patterns would indeed be the bull flag. Now, this continuation pattern resembles a flag at the top of a pole. The bullish flag is a short-term continuation pattern which tells you that a temporary market consolidation is occurring before a continuation of an uptrend. Now, within this pattern, the flagpole is represented by a sudden vertical spike or impulse move in price, as the flag portion is represented by a temporary downward consolidation against the uptrend. Now, typically, bull flags are angled downward from the predominant trend. However, on occasion, it can be angled upwards. The continuation pattern is complete once price action breaks above the upper resistance trend line. Now, a typical price target is measured by adding the length of the flagpole to the price associated with the bottom of the flag. Again, the measured move is from the beginning of the impulse move added to the upper side of the top resistance trend line upon the breakout. So your confirmation to enter into a long trade here will be when the price closes above the upper trend line. To confirm this is indeed a bull flag pattern, you are looking for at least two touch points on both the downward support and the downward resistance trend line, and this pattern breaks to the upside about 64% of the time. Okay, the bull flag's evil twin, the bear flag. Now, this continuation pattern again resembles an upside down flag. The bearish flag is a short-term continuation pattern, which tells you that a temporary upward market consolidation is occurring before a continuation of a downtrend. Now, again, the flagpole is represented by a sudden vertical dip or impulse move to the downside in price, as the flag portion is represented by a temporary upwards consolidation against the downtrend. Now, standard bear flags are angled upward or sideways from the dominant downward trend. However, on occasion, it can be angled downward. The continuation pattern is complete once price action breaks below the lower trend line of support, and a typical target or measured move is measured by subtracting the length of the flagpole to the price associated with the top of the flag. These are also called half-staff patterns, something that I may or may not have mentioned when it came to bull flags, but you take the measured move essentially the same way for both of these patterns, just in reverse. So confirmation to sell is when you get a candle body close below the lower trend line. Your pattern confirmation, again, the same way with the bull flag, you get at least 2 touch points on both the support and the resistance lines, and the percentage of time that bear flags break to the downside is about 64%. Okay, so these are some of the 5 most common continuation patterns that you will see in price action. And as I mentioned at the beginning of this video, there are a ton more. If you're looking to dive a bit deeper into continuation patterns, you do have access to Bukalski's 2nd edition encyclopedia of chart patterns. That is included with your membership. So all you have to do is go to the TA library and go into PDF text, and then go through the ABCD and find the 2nd edition chart pattern encyclopedia by Thomas Bukalski, and go ahead and dive a bit in there. We will go through some more continuation patterns at the end of this lesson, but for now, make sure that you do get a firm hold on these 5. All right, let's move on to reversal patterns.